Airline sector, fuel cost and capacity discipline trends. Let's look at the exact numbers driving airline stocks in 2026.
Airline stocks are facing a critical 2026 test. Fuel costs are still elevated, but capacity discipline could determine which carriers protect their profits.
The 2026 fuel shock. Let's dive right into the macroeconomic trigger that's impacting the entire airline sector right now.
Get this, in June 2026 alone, U.S. scheduled service airlines spent a staggering $5.99 billion on jet fuel. That represents a massive 60.6% year-over-year increase. When one of your absolutely largest variable costs spikes by over 60% in just a 12-month window, it flows immediately into your operating margins.
But here's what makes that $5.99 billion expense even wilder. It's the consumption data. Airlines consumed 1.668 billion gallons of fuel in June. That is actually a 1.0% year-over-year drop in volume. So airlines are physically flying less fuel, yet paying dramatically more for it. This perfectly illustrates just how severely these elevated jet fuel prices are hitting the bottom line.
But don't look away just yet, because the data also shows us how incredibly fast this volatility can swing quarterly earnings. The average fuel cost per gallon in June actually fell 12.2% month-to-month from May. For us investors, tracking this month-to-month turbulence is absolutely crucial. A falling crack spread can rapidly improve airline economics, even if crude oil itself stays elevated.
Capacity discipline explained. Since airlines cannot automatically pass every single fuel cost increase directly onto passengers, management teams are forced to rely on the industry's strategic response. So, what is capacity discipline? It simply means controlling how many seats an airline puts into the market relative to expected demand. Look, in a low-cost environment, airlines might add flights aggressively to capture market share. But in 2026, with airline fuel costs surging, that strategy completely backfires. Adding way too many seats when fuel is expensive forces airlines to discount fares just to fill those planes, which absolutely crushes their margins.
And this brings us to the multiplier effect. If consumer demand remains stable and airlines deliberately slow their capacity growth, it creates real pricing power. By tightening up the supply of available seats, carriers can defend higher ticket prices. This allows them to absorb that fuel shock without needing oil prices to magically crash back down to previous lows.
Key airline metrics to find. Before we look at specific 2026 stock signals, let's do a rapid-fire glossary breakdown so you're anchored on the metrics you need to evaluate these carriers. First up is RASM, or Revenue Per Available Seat Mile. This is the ultimate measure of unit revenue. It tells you how successfully an airline is monetizing its capacity and passenger demand. If a carrier's RASM is rising, they're successfully pushing through fare increases or shifting to premium, higher-yielding routes.
Second is load factor. This one's simple. It's just the percentage of available seats that are actually filled by paying passengers. It's a vital indicator of efficiency. You really want to see load factors hold steady or climb, even as airlines manage their capacity.
Third is CASM-X, which stands for Cost Per Available Seat Mile, excluding fuel. Listen, a falling jet fuel bill does not automatically mean higher profits if other costs are surging out of control. Labor, maintenance, airport fees, and fleet costs matter just as much as the fuel bill. CASM-X isolates those operational expenses so you can evaluate management's true core cost control.
If you're finding this analysis useful, subscribe to Fox of Wall Street, like this video, and share it with another investor who follows the stock market.
Stock by stock carrier breakdown. We are seeing a major divergence in how individual carriers are actually executing their strategies right now. Looking at the four majors, DAL stock and UAL stock are demonstrating a really strong ability to absorb the shock. Delta reaffirmed its full-year 2026 EPS outlook of $6.50 to $7.50 despite all the volatility. That signals a powerful pricing defense and a very deliberate reduction in capacity growth. United actually raised its full-year outlook after Q2, leveraging their robust demand and network strength. But on the flip side, AAL stock and LUV stock are facing some much tougher execution challenges. American is a serious profit conversion risk right now. Their second quarter fuel expense jumped an incredible 83% year-over-year, and they are having to trim their fourth quarter growth just to cope. Southwest, meanwhile, lowered its 2026 profit floor entirely. Higher fuel costs blunted their pricing improvements, which makes their turnaround highly dependent on strict cost control moving forward.
Bull case versus bear case. When evaluating the broader market for the remainder of 2026, we're weighing two distinct paths.
The bull case relies on margin expansion through sheer discipline. If fuel prices stabilize or fall and airlines resist the urge to flood the market with excess seats while demand stays resilient, those fuel savings will flow directly into free cash flow and margin expansion. The bear case? It's the exact opposite. Geopolitical disruptions send jet fuel prices spiking again, while carriers mistakenly return to aggressive seat growth. If overcapacity collides with expensive fuel and weakening consumer demand, fare pressure will intensify, and that sector earnings leverage will reverse rapidly.
The ultimate investor checklist. To navigate all of this, you need a definitive scorecard for evaluating airline profitability.
Here is your essential 8-point checklist. First, track jet fuel prices and the crack spread, not just crude oil. Second, watch airline capacity growth relative to passenger demand. Third, ensure demand itself holds up. Fourth, verify that unit revenue, that's RASM and yield, are actually rising. Moving to the cost side. Fifth, monitor CASX to ensure labor and maintenance aren't quietly eroding margins. Sixth, keep your eye on the actual operating margin. Seventh, look for strong free cash flow generation. And finally, number 8, track net debt levels. Airlines are highly capital intensive, so they absolutely must manage their leverage effectively.
Bottom line, in 2026, capacity discipline may be almost as important as fuel prices for airline investors. So with this scorecard in hand, which carrier are you betting on to navigate the turbulence ahead?